What's happening all? It is Tuesday the 12th. Sorry I didn't get anything out on Friday. It was one of those just wild days. I started with the intention of getting it happening, and then it just everything kept slipping away, slipping away, slipping away. And I was trying to get out of town for the weekend. Me and my wife hadn't really had a chance to spend any time, just us, in a long time. We've always been up in the hills, hung out. That was it. Just hung out for a couple of days, got back. Crazy man, the wind came through where we were at, and it was a northern wind coming in and just froze the hell out of us. So we had to relocate our rig to a spot, had a little bit of a wind barrier, but ended up being a really good time just to shut off for a couple of days, come back and get right in the saddle again yesterday morning. So Monday morning I was right back in, get it knocked out. To the market, really interesting stuff going on here with what's happening with the political scene, right? So when you have at least the sentiment to this point is that if there was a Democratic win across all sides, that it would be very, very bad for bonds. And what we're seeing is that starting to play out. We're starting to see that even when you have, the ADP report come out, and we're showing that the non-farm payrolls being just absolutely dismal, right? They're looking somewhere in the range of looking for 120,000 new jobs. And then we end up getting 140,000 lost jobs. That hasn't happened since the wheels fell off the economy last year, back in March. So now we're seeing things just way worse than anticipated, but yet stocks are at this euphoric level, which doesn't make any sense whatsoever. And then we start looking at what's going on in the bond market, because that's what drives our interest rate, guys. How much money is being put into long-term instruments, mortgage-backed securities. And when there's more capital going in there, you're going to see interest rates go down. When that capital starts to leave, you start just seeing interest rates go up. Well, what we found is that 4 times as many puts have been put in than purchase calls for purchases than calls. So ultimately, traders buy puts when they're betting the market's going to fall. So when you're talking about that and you see big money players still selling against things like what we're hearing about payrolls and the economy weakening, it's pretty concerning to see what's happening there. So they're looking for this bottom at this point. You're going to hear a lot of mortgage back, at least a lot of mortgage companies or online companies talking about the interest rates going up, which in a way, we are seeing those go up. But I'm, me following the 3.0 UMBS for my investors, I'm not seeing the volatility. So let's take a look. Let me show you exactly what I'm talking about here. We're going to look. We still see volatility, of course. Let me change that. But look at the 3.0. We're still staying. It's a fairly wide channel that is staying within. We're seeing some big movements as of the 6th, which was also a very concerning day. That was when there was a lot of stuff going on the 6th. But what was really crazy about that? If you look back here, the 6th. This here is the 7th. Got here the 8th. This is, I guess that was yesterday, the 11th. Today the 12th, right? So now let's go into more of the spots that people are going to quote from, like your bankrate.coms, your big companies. Now look at this. Look at where we are here. Here's the 6th, 7th, 8th, yesterday, today. Look at the beating that the lower coupon bonds have taken. Let's go into the 2.5. So when you're seeing all this news come about going, and the interest rates are going up, they're not wrong. But what they're showing here is for the people buying homes to live in. That's where they're targeting for that. For those of you that are buying investment properties, especially with where we're pricing at, we're not seeing that volatility. It's still volatile. There's still a lot going on, but not to the extent of what you're seeing there. Why? I can't speak to that. I'm guessing. This is what I'm guessing at. If people are getting out of bonds, right? They're getting out of an instrument like, like the mortgage-backed securities. I don't know if they're 100% leaving it. They might be going into a higher coupon. That's a guess. I don't know, because I'm not seeing the trades. I don't have access to the trades. But if they're going to a higher coupon because, we're not confident in the economy, they may be worrying about what things are coming, which they should. There's plenty of evidence to worry about that. But at the same time, they're not getting out of mortgage-backed securities entirely. Maybe they're going over here. Look at the 3.5. It's very, very strong. So that's my guess on that. I can't be 100% certain on that. So what that tells us, as far as those of you who are buying investment properties, those of you who are getting the long-term 30-year fixed, so far it's following exactly what I've been talking about. Staying within this channel, not massive movement towards coming out of channels rapidly, like we saw with the lower return coupons. One of these other things I found interesting this morning, of course, following Barry Habib, you've seen him on here before, long time back, or last year. He put out this chart with respect to the market sentiment that put out by Citigroup. This has to do with the stock market. Now, he had indicated that euphoric levels are like 0.4. That would be where there's like this crazy buying in the market, way too much optimism. We're at 1.83. That's more. That's the stock market. Look at that insanity going into the stock market. So the thought process here is that's also pulling a lot from the mortgage-backed securities, this euphoric thought process of going into stock, when with payrolls and with where the economy's sitting, that doesn't make sense to me. But a lot of the buying within the market has made a little sense to me. Maybe I just don't have the inventory of information to be able to dissect that and understand what's driving the traders or driving people to go put so much capital into the stock market. I guess there's a fear of loss situation here. I mean, granted, things have grown significantly. If you had money in there a year ago, you probably are amazing returns, but you got to get out to get a return. So right now, I'm continuing to follow the mortgage-backed securities, see where they're going. Interest rates are staying fairly steady for the mortgage-backed securities or for the real estate investor. I'm not seeing a ton of movement in there. Yeah, we're seeing little tiny bits here and there, eighth or a quarter here and there, but nothing to the extent the person needs to stress about. Again, guys, don't worry about this. Don't put so much strain into this, especially when we're talking about these interest rates in the threes. For a 30-year fixed on an investment property, 20% down, 740 plus credit score. I don't understand why one would concern too much between an eighth or a quarter percent, especially when the cost of the value of the dollar is losing 7% of its value. When you look at the real cost of living, you're not losing anything. You are making money all the way around. Plus, anything you pay in interest, talk to your CPA. There's tax deduction there that you can take advantage of. So there's many things to benefit you regardless of what the rates are doing. But right now they're phenomenal. I'm not seeing anything that's going to indicate one way or the other in the coming days, but I'm going to continue to just keep updating you as often as I can. And I'll talk to you guys again on Friday. Thank you for watching.